Okay, hello everybody. Welcome to Korean Atlanta Mentorship. So, if you have a low interest rate mortgage and you're thinking of replacing it with a first lien HELOC because the internet told you to do that, you might want to check out this video. So, this video was actually inspired by someone who reached out to me, and he had a 2.2% mortgage and was like, should I get a first lien HELOC? And there were some cash flow issues there. I'm not going to get into it too much. And I didn't give him my opinion. I just said, look, here's the math, right? Here's what happens. You decide what you want to do, because you got to be the leader of your life, right? But all I can do, kind of like Morpheus in the Matrix, I'll show you the door. You just walk through it. You want the red pill or the blue pill? I know it's kind of outdated nowadays because the Matrix 4 was awful, but but I just want to show you that sometimes you shouldn't just do things on our internet because it's promoted, right? Like if you have a 2.2% mortgage and you place it with a 10% line of credit, first lien HELOC, might want to rethink about that, right? And again, I'm not going to tell you if it's bad or good. I want you to do the math yourself and make your own decision. Now, I didn't tell you a little bit about myself. When I first learned velocity banking in 2017, there was an instructor. His name is Randall. He's the one who made this velocity banking spreadsheet that I always reference to because I originally learned velocity banking in 2017. And one of the things that he said is that, if there's an interest rate difference, you don't want to really replace that loan with a line of credit, right? Like if the loan is like a 4% loan and there's a 10% line of credit, you don't want to do that, and you want to do the chunking method because that's kind of resistant to the interest rates. And if you don't know who Randall is, just look up Renatus Randall Cloud, right? And then they should have, right, Velocity Banking Randall Cloud. He's the instructor. He's the one who I learned it from. I think he's younger than me, right? So he's the one who came up with the calculator and was an instructor, or currently is the instructor of the latest updated class. And so, again, I'm just going to show you with just basic principles, math, about replacing your first lien HELOC, your mortgage with first lien HELOC, and there's a substantial interest rate difference, right? And one other thing that we also have to consider is that the mortgage is the loan or the debt that we usually want to pay off last because it takes up so little of our cash flow, usually compared to other debts, right? But I'm assuming that all of our other debts have paid off. We have a $200,000 loan at 2.2%. Again, the gentleman who reached out to me had, I think, a 2.2% loan. It was really insane. And he was asking me, like, should I get a 9% line of credit? And I was like, well, this is what's going to happen, right? So let's go ahead and get a huge line of credit, and we'll replace this $200,000 mortgage with a $200,000 line of credit, right? And so let's go ahead and do that. Now, what happens to the payment once the debt has been transferred? Well, this increases, so now our cash flow is 2,500, right? This goes to zero, cash flow goes to 2,500. Now, in our expense calculations, after every single month, we also have to add the interest that accrues during that month, right? We also have to add the interest. So let's go ahead and do this. Just do the same formulas that we always do. I2 plus 1, and then it'll be G2 plus H2 minus our cash flow, which is 2,500. So basically, you get the next month's balance by adding the previous month's balance to previous month's interest minus our cash flow. Now, we also have to calculate the interest, and because it is at a 10% interest rate, we get the average daily balance, right? Multiplied by the interest rate divided by 12. And the interest calculated with the line and loan is almost exactly the same because the statement, like the way that a loan calculates the interest is by the statement balance, right? Um, and it's if you only paying a loan once a month, then the statement balance is essentially the average daily balance, if that makes sense. So hopefully it doesn't. If it does, just realize that loans and lines of credit is like simply replacing your 2% loan with a line of credit isn't magically going to make the interest disappear, right? Like what's more important is that we maximize this cash flow number and use a line of credit to help us as a tool to do that. So let's go ahead and copy and paste this and see how long it takes us to pay off. that loan or that line of credit. And so let's go ahead and do this. All right. So as you can see here, um, let's go ahead and do this. 131 months, so 131 divided by 12. So it's about 11 years, right? 11 years. Okay, so 11 years to pay off. Now, let's also sum up the interest, right? So let's go ahead and do this. I'm going to sum up that interest, and we pay about $127,000 in interest. Now, we have this thing called a velocity of banking calculator that genius Randall that I talked to you about came up with. I'm not associated with him. I've talked to him a couple of times before, but I don't think he even knows I run this channel. But he's the one who came up with this spreadsheet. And again, full disclosure, I'm not what they call an independent contracting marketer of Renatus, meaning I kind of make commission off of selling their product. So do I have an interest in promoting Renata? Sure, but I'm not an employee of them or anything like that. So here's the thing. If I'm going to put in the numbers here, and the cool thing about this calculator is you just put in these numbers, right? And this calculator is like way more detailed than whatever it is I'm doing, right? Because as you can see here, you put the loan, and then let's say you decide that you're going to put the entire thing into a line of credit, the system will know how to calculate that, or the spreadsheet will know, right? So let's say that we're doing what we just demonstrated here. I have my own way of calculating, but Randall's method is probably a little bit more, or is probably more accurate. I don't know how much more accurate, but we'll have somewhat of the same numbers, okay? So let's go ahead and just do $200,000 and replace that whole thing with the line of credit that's 10%. That's what this means. And we have our income and then our expenses. So we put that number. Now take a look at this. Okay, this is the crazy part. So 11.1 years. What did I write? Yeah, about 11 years. Well, I kind of rounded it up from 10, but very similar. So you might be thinking, oh man, like 30 years, who wants to pay off a 30-year mortgage when you pay it off in 11? Okay. So we did actually speed up the payment, but take a look at this. This is a crazy part, right? You actually pay $61,000 more in interest. That's what the brackets are saying. $61,000 more in interest than you did if you just never did if you never had replaced your line of credit, your 2.2% mortgage with the line of credit. Yeah, you pay it off faster, but pay more money. The bank will certainly love that, right? And if you take a look at here, again, it starts at that $200,000 balance, and then it's okay, replace your entire mortgage with the line of credit, and then you can see it calculates everything accordingly, right? Much more accurate than the way that I do it. But my point is this, right? If you This is what Randall taught me, and he actually goes over this in the current iteration of velocity banking class in Renatus. There's no real difference. There's a very minor difference between how loans and lines are calculated. The interest, right? The whole point of this is that you use this as a tool to stop segregation of income, right? And if you're going to use a line of credit to pay off your loan, you could just do it in small chunks. So, for example, let's say I decide that I'm just going to move a $5,000 chunk into the line of credit, meaning one 195. Like this means that the balance is 195, right? 195. Then I just move into a line of credit, and you'll see, yes, we're paying a lot less interest, right? About $54,000 less, and the time frame to pay it off is 7.3 years, even though it's a 10% line of credit, right? So now this makes it easy to dump all of our money in, use our cash flow to pay off our line of credit. But if we do the whole thing, $200,000, right? We're paying $134,000 of interest. And take a look here. Again, our numbers are going to be a little bit off. I would say Randall's is more, I'll say more accurate, right? Just because, my calculator is just very like third grade mathy, but it'll give you an idea of how long it'll take. So 11 years and 127,000. His calculator says 11 years and 134,000. But the point is that you don't have to replace your mortgage with the line of credit. You see, you just do that chunking method where you take little pieces of the loan to the line of credit and pay it off over and over again, right? Like you just do that. But I hear these things on the internet, and I remember like, man, 2017. I remember Randall said this, and then he said it again in the last updated class in Renatus, and it's like, well, this is why I promote Renatus because we're not teaching things that might get people into and that, when I say we, I'm saying just in general, um, into hot water, right? Like if you had just only do $5,000 chunks and you're getting the same effect, and you're preventing segregation of income, and it's easy for you to pay off, and it's easy, all these other benefits without having to replace your whole 2.2% mortgage with the not 10% line of credit. Yeah, that okay, like I see benefits in doing that. I mean, you could even argue that just doing direct extra payments, if you could do that, why would you need a line of credit? And I say, yeah, go for it, right? Like, but what you don't want to do is you don't want to pay a lot more to the bank, $200,000 here. Like, why would I pay $61,000 more just to accelerate the payoff? Like that no, right? So let's even accelerate the payoff more, 7.3 years, and pay only about 18 grand of interest, right? I'm good. I'm game, right? So again, don't just like if someone tells you, "Hey, just replace your mortgage with the first lien HELOC," and it makes absolute like you're not doing the math or just verifying yourself and just listening to the internet, you probably get yourself in some hot water. Now when it might it be appropriate to be able to do that, I don't know. Well, if the interest rate is comparable, so let's say 200,000, right? So 200,000, and then let's say we had a 2.2% interest rate. Yeah, okay, you sure. Like, but then no, like very here's the thing, because of the two-way access that a line of credit has, you basically have more features in it than a loan. Think of it in terms of software packages. Remember how the free or the low-cost version of certain software packages, or maybe like Netflix or Hulu, you don't have as much features in that debt product. It's the same thing with the line of credit. Like banks aren't stupid. They're not going to price a line of credit similar to a loan unless it's like a special promotion. And if you can get like a 2% line of credit, and again, they might exist. I just don't know. All I know is that I see like 10%, 9%, 7% at the least, 7% on a home equity line of credit. Um, Never seen two. And if you see a two, I'm going to jump on that tomorrow. You know what I'm saying? But in general, because they know how valuable that the two-way access is, they just like a software package, the more features you have, the more that they can charge, right? That's why a line of credit usually has a higher interest rate. And the problem is a lot of people kind of freak out about that. But if you know how to use it appropriately, then that 10%, even 30%, not really that big of a deal, right? Like if you know what it is that you're doing, and I talked about previously, like, hey, you charge maybe 5-10 grand on a Discover card to pay off your mortgage with Plastique, and you're frustrated because you only got a $6,000 credit limit, right? Then if you keep using it over and over again, you'll probably have your credit limit increased in no time, right? Okay, well, that's just it for today. So it's kind of like the message of the day. And let me just do this. Let me humble brag that I kind of think I know what I'm doing because I paid off a mortgage in 3 years, under 3 years. But maybe I'm just delusional, like Joaquin Phoenix in The Joker, where I just made it all up in my head. I don't know if you've ever seen that movie. Oh man. All right. Well, that's it for today's Korean Land to Mentorship. Everyone, have a great day.